Despite the current real estate slowdown, home values could fall by as much as 30%, and mortgage rates could rise to 7%. A new policy has been issued that will make it easier for buyers to get accepted for a loan by lowering credit score requirements. Even though this would allow many more individuals to qualify for a home, some analysts worry that it comes at a time when deals are being cancelled. Inventory is increasing, and the prospective buyer might not be completely informed of what is about to happen in the housing market. Let's discuss the upcoming verified changes and their potential effects on the housing market as a whole, and whether or not home prices will fall by the second most since World War II. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. As most of you know, your credit score is the most important aspect in personal finance, wealth, and real estate, but that's changing. That's because new reports showed that 53% of Americans are denied loans due to bad credit, prompting Congress and big banks to develop a new credit scoring algorithm that would replace the current system, allow people to get loans without a credit score, and take into account new items that could help or hurt you depending on the circumstances. In the housing market, even while the average mortgage borrower has a credit score of 725, 35% of Americans have a score below 680. So increasing credit worthiness across a bigger pool of purchasers will make home more accessible and affordable for those who know what to search for. This isn't simply a senator's suggestion or speculation. Actually, it's happening. Thus, it's important to understand what's happening, how it will affect you, and what you can do to take advantage of it. Alternative credit scores start everything. As it stands, borrowers have 5 primary criteria if they want to get authorized at the lowest rate. The first and largest aspect is your on-time payment history, which accounts for 35% of your score. This means you never miss a payment or are late, and the longer you've paid your bills on time, the better your score. The second biggest factor is your utilization rate, which accounts for 30% of your score and compares how much credit you have to how much you use. The lower the ratio, the better your chances of improving. Third, the average age of your credit accounts for 15% of your score. Lenders believe that the longer you've had accounts open and in good standing, the more responsible and experienced you are. Fourth, your credit categories make up 10% of your score. Lenders like to see that you've paid off many credit cards, auto loans, personal loans, and mortgages in different amounts. Finally, 10% of your score is based on the amount of credit inquiries you have. When you apply for a new line of credit, it shows up as a hard inquiry on your report. And more inquiries you have, the lower your score will be, because you're a risky borrower. And even though this has been tried and true method of building credit for the last 20 years, lenders realize that this might exclude great, well-paying, responsible people who should be getting a loan but can't because they don't have the knowledge, means, or need to go and borrow money to build their credit score. So they came up with a brand new solution called FICO 10T and the Vantage Score. First, FICO scoring methods are updated every few years to account for new data, trends, and spending habits. For example, FICO 8 ignored small unpaid balances less than $100. FICO 9 began accounting for buy now pay later balances, and FICO 10 could see if your spending habits were increasing over time. As said, 45 million Americans didn't have a credit score, one of the system's biggest faults. 40% had no understanding how the ratings were calculated, and 53% were rejecting owing to bad credit. That means a significant portion of the population does not have access to affordable financing, the ability to buy a house, or the chance to leverage their money. But big banks and Congress are beginning to change that. Under this new program, banks would be allowed to take other aspects of a person's finances into consideration, like their average account balance and whether they've ever overdrafted. The Gadget Score anticipated that 72,000 more households would be able to acquire credit each year, opening up finance to many more people. Second, Fannie Mae and Freddie Mac allow FICO 10T and Vantage scores for house loans. As MarketWatch explains, both FICO 10 Team Vantage scores look at a broader range of payment history data for borrowers, from cell phone bills to utility and rental payments to determine creditworthiness. Their studies have found that if you pay your rent, utilities, and phone bills on time, you're likely to pay your mortgage on time, even if you don't have a traditional credit score. Here's how this will affect you and the real estate market. Although before we go into that, even though we generally talk about publicly available investments like stocks and real estate, most people are not aware that it's totally viable to invest in privately held companies pre-IPO. Okay, before we address the effects of the new credit scoring model on the housing market, we need to discuss home pricing, since there is a lot of new information. First, a recent analysis indicated that home prices are still higher than a year ago, but increases are dropping at the fastest pace since they started reporting in 1987, indicating that housing growth peaked in the spring of 2022 and has been declining ever since. Now, in terms of which city saw the largest price drops, San Francisco down 4.3%, Seattle down 3.9%, and San Diego down 2.8%. But I have to say, when it comes to real estate, no one seems to be quite as pessimistic as finance professor Jeremy Siegel, with mortgage applications at the lowest level since 1997. He believes that housing prices will decline 10 to 15% over the next 12 months, and the second biggest housing decline since post-World War II. Mark Zandi adds that most declines will happen sooner rather than later, and that property values would fall 20% if there's a typical recession. 3. Banks and lenders may want to provide more loans and find a simpler way to do so. This would allow 45 million additional Americans to borrow money, which could be major business. It's too early to say, but opening up new financial choices may be a positive move for this business, which relies on customers paying them back. I mean, if we see 45 million people rushing into the housing market all at once, it could be a disaster. But most likely, the people who are barely on the edge of getting approved will have an easier time getting a loan, and to a small degree, it could lead to a slight increase in sales. But realistically, it's probably not going to have that big of an effect on the market, since they've already have to come up with a down payment, have sufficient employment history. I am a fan of anything that promotes credit accuracy, and I think it's a step in the right direction. The traditional system of getting a credit card, charging it, and then paying it option 4 to build credit is ridiculous, and there's no reason phone, utility, and rental payments shouldn't be used in conjunction with everything else. However, there's certainly the suspicion that banks are pushing for less restrictions, so they can issue and sell more loans. But in the big picture, I don't expect this to have a major impact on the market. And if anything, it's going to take some lenders time to adjust to, so we're unlikely to see anything happening in the short term. Although I tend to agree with analysts that housing prices have to come down because current prices are too high. Even for investment buildings, it makes little sense to acquire a property at 4% when treasuries are paying 4.5% risk-free. In a normal market, property would have to sell for 7% to even make it worth buying, which leads me to believe that the market will continue to cool down depending on the area, and as long as the Federal Reserve is increasing rates, we're likely to see some downward pressure. Plus, real estate is cyclical and the market has already. One economist predicts a new bull market for stocks, bonds, and other risk assets starting in 2024. So, don't despair. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.